Noble Energy says that by 2020, we will need $272 billion worth of investment in new oil pipelines in the United States and Canada just to keep up with demand. So when you talk to your advisor, ask, number one, how can you best invest in the shale revolution? Number two, what is our energy investment plan if prices fall or rise? And number three, what will the Saudis do if they diversify away from oil? Energy is going to be a huge impact on all our investments, not just our energy investments. If Saudi Arabia diversifies away from oil, or if the dollar loses its reserve currency status, all of these will have an impact on your investments. And you need to have a plan with your advisor on how you're going to address it. But before you can talk to your advisor, let me give you a little briefing on being an intelligent energy investor. So when you ask your advisor what you should invest in, here's some things you need to understand. There are really three areas of energy that you can invest. We call them upstream, midstream, and downstream. Let's talk first about upstream. Upstream is E&P companies. That's exploration and production companies. Those are the companies that go out and look for oil, and they drill for oil, and then they produce it. And it's also those companies that serve them in that process. So generally, upstream companies benefit from higher oil prices, not lower oil prices. It's a lot more attractive when oil is $70 a barrel to drill for it than when it's 30 or 40. There are also a wide variety of E&P companies. You've got wildcatters and the small operations, and then you've got very large operations with strong balance sheets. There is a risk-reward ratio in investing. Sometimes when you take more risk, you can have the potential for better rewards. Well, the same is true in energy. If you invest in one of the smaller plays and they have hit it big and oil prices are strong, you can make a lot of money. On the other hand, if they come up dry, you can lose a lot of money. The larger companies tend to have more stable investment parameters. Here's a good example from a Motley Fool article in October 2017. It says the 33% plunge in oil over the past 3 years caused Sanchez Energy stock to crater nearly 80%, while ConocoPhillips stock is down only 27%. Well, in a big oil price decline, ConocoPhillips held up much better than Sanchez Energy. You can also invest upstream by investing in oil field services and equipment makers. They're also price sensitive, but think of this, in the gold rush of California, if you sold picks and shovels, you had a steadier investment and you were able to diversify a little bit. So oil field services are another way to invest upstream. There are exchange-traded funds that invest in multiple exploration and production companies. And then, of course, the integrated oil companies, the great big ones, they have upstream, midstream, and downstream. They're integrated, meaning they have all three components. So upstream is where you'd invest if you think oil prices are going higher. Midstream is more like the toll booth of the energy superhighway. There's an enormous need in this sector right now because we're producing energy that a few years ago we never expected in North Dakota and West Texas and so forth, and we don't have the pipelines or the transportation infrastructure. So what's happened in a lot of cases is they put oil on rail cars and shipped it on rail cars. But we're developing pipelines, and there's enormous need to continue to build those. And so the midstream investments would be like what Troy Andrews' company did. It was privately held, but it's what they did. They put a lot of money and built a pipeline. It's very infrastructure intensive. It's generally based on transportation, logistics, technology. And so it could be, midstream investments could be rail, barge, pipelines, or transloading. Transloading is a technical term when you take it from one mode of transportation to another. Maybe you take it from the drill site to the pipeline, and so you put it on a rail car and ship it and then take it off, transload it onto the pipeline to go where it needs to go. Now, one aspect of midstream investments is that they tend to be a little more energy price neutral. As long as there's supply and demand for oil, for example, the pipeline's going to get its toll. In fact, the oil prices could drop as long as there's oil flowing through, they're going to get paid and the investor's going to make out. Generally, these are dividend yielders, and they come in the form of what's known as master limited partnerships, or MLPs. So that's the historical structure that's been used for midstream investments, that and private equity. So the third area of energy investing is downstream. And these are companies that convert crude oil and natural gas to products that we can use as consumers. Some of the attributes, refining and marketing companies. So if you go down the highway and you see a gas station, whether it's Phillips 66 or whatever, Exxon, that is refining and marketing. So they take crude oil into the refinery, they refine it into gasoline, jet fuel, diesel fuel, things that are used in petrochemicals, other byproducts, and then they ship it and sell it to you. Now, refineries, marketers, downstream investments actually sometimes do better with lower energy prices, not higher energy prices. And that's because, let's say you're a fertilizer company and your feedstock is natural gas. If natural gas prices are lower, your cost of creating the fertilizer is less. And so you make more money, your margins can increase, and you can sell more fertilizer. Integrated oil companies also have downstream marketing opportunities. So integrated, you cover kind of all three of them, or you can focus on upstream, midstream, or downstream.